In his first week of office, President Trump signed a record number of executive orders, totaling 26 on his first day alone. That speed of change sets the tone for the next 4 years, which promises to be anything but predictable. I'm Mark Kinney, Chief Investment Officer at Newport Private Wealth, with your fourth quarter update. This includes highlights from our investment activities and how we're positioning portfolios for long-term growth. I'll also cover key topics on everyone's mind, including tariffs, the weakened loonie, and inflation. Let's begin with an update on performance. Newport's 5 mandates returned between 2.14 and 2.36% in the fourth quarter, and full-year returns ranged between 9.63 and 10.58%. After a year of outsized returns in public equity markets, this appears muted by comparison, but that's by design. Newport mandates consist of 13 asset classes, with public equity making up approximately 45% in a balanced mandate. In contrast, many balanced funds hold upwards of 60% in stocks or more. We diversify through alternative asset classes such as real estate, private debt, private equity, and infrastructure. This broader investment universe enables us to achieve more consistent returns with less volatility for your portfolio over full market cycles. Managing volatility is key, especially during market downturns like we saw in 2022. In a year where public markets were down more than 10%, our private asset allocations returned nearly 9%. Since 2011, our strategy has consistently captured nearly 80% of market gains over time. More importantly, during downturns, our clients have experienced just over half of the market's declines. This approach allows our clients to participate meaningfully in market gains while mitigating losses during downturns. When compounded over time, consistent performance preserves wealth over the long term and funds your lifestyle. This is exactly what you entrust us to do, and it's the foundation of Newport's approach. We focus on deploying new capital and tactically repositioning existing investments across managers and asset classes. In Q4, the investment committee allocated nearly $160 million, bringing 2024's total to approximately $455 million. Let's review highlights of some of that activity, beginning with bonds. The bond market underwent considerable shifts in Q4. The 10-year U.S. Treasury bond faced extreme volatility as recession fears drove investors towards safer assets. As the Federal Reserve cut interest rates, yields rebounded to 4.6% by December, reflecting market adjustments to evolving economic conditions. We saw opportunity in this activity and allocated nearly $35 million to public bonds. This included investments in high-quality Canadian corporate bonds made more attractive with improved yields. Looking ahead, bonds will remain a key defensive tool in our portfolios. Whether through future rate cuts or periods of market stress, these investments provide income, stability, and protect against market volatility. Private markets continued to demonstrate their value as a source of diversification and resilience. We allocated $17 million to a U.S.-based private equity manager specializing in the secondaries market. This allows us to access private equity investments at a discount, enhancing potential returns. It aligns with our commitment to securing high-quality investments and partnerships for long-term success. Another $20 million was directed to a private debt manager focused on mortgages and consumer loans. Private debt offers key advantages in today's environment, offering higher yields than public bonds with reduced volatility. Many private debt instruments feature floating rates, providing a natural hedge against inflation or rising rates. We remain committed to multifamily real estate, focusing on premium properties, including this quarter's investment in a garden-style residential complex in Louisville, Kentucky. This sector will benefit from falling interest rates, a stabilizing housing supply, and the ongoing high cost of home ownership. Our REIT portfolio delivered strong returns in 2024. To maintain equity weightings at target levels, we are trimming positions carefully and reallocating some of these gains to new opportunities. Private mortgages play an important role in our yield strategy. During the quarter, we allocated $15 million to a trusted partner who we've worked with since 2002. This asset class remains a core component of our portfolios, offering consistent returns and diversification from traditional fixed income investments. Shifting to public equities, markets continue to experience strong gains with broader participation in the quarter. The S&P 500 advanced, while small and mid-cap indices also posted double-digit growth. A healthier market aligns with our diversified approach. Despite this, the Magnificent Seven continued to dominate, contributing over half of the S&P 500's returns. We hold positions in all seven, allowing us to participate in their continued strength. During October's sell-off, we deployed $70 million across global markets, contributing to our total investment of nearly $245 million in public equities in 2024. While U.S. growth hinges on earnings momentum and lower interest rates, policy uncertainty is likely to drive market volatility. We see these disruptions as opportunities for selective capital deployment from our cash reserves. We are also monitoring our exposure to emerging markets amid tariff risks and currency fluctuations. As the year progresses, the evolving economic and political landscape reinforces the need for a disciplined, proactive approach to managing risks and opportunities. Global growth is uneven. Despite rising financial pressures on middle-income households, the U.S. economy remains resilient, driven by strong consumer spending. In contrast, Canada grapples with high household debt and the threat of tariffs. China's slowdown and Europe's modest recovery and political instability further complicate the global picture. The Canadian dollar has depreciated 15% against the US dollar over the past 3 years, creating challenges for exporters and GDP growth. A weaker dollar could further increase import costs and add inflationary pressure. In response, we are reviewing our hedging strategy to manage currency volatility. With 45% of our investments in US dollars, our portfolio remains well diversified against severe currency shifts. On February 1st, President Trump enacted a 25% tariff on Canada and Mexico, alongside a 10% tariff on Canadian energy. While these potential tariffs have been delayed by 30 days, the uncertainty of them becoming real will remain a risk to financial markets and economic growth. Regardless of what the next few weeks bring, what is certain is that these measures will have significant economic consequences for both Canada and the United States. Projections suggest that the tariffs could shrink Canada's GDP by approximately 4%, depending on how businesses and consumers adjust. This all has a direct impact on inflation. It remains near 2%, and with excess supply, the Bank of Canada recently cut rates to 3% to support household spending and gradual recovery. Rather than reacting impulsively, we assess all factors, whether economic shifts, currency moves, tariffs, or inflation, to make informed decisions. Our primary goal is prudent risk management and thoughtful allocation while striving for consistency. As we enter 2025, we are ready. Experience shows that challenges bring opportunities, and we remain agile, disciplined, and focused on your long-term financial well-being. Thank you for your continued trust in Newport. It is a privilege that we do not take lightly.